Hello. Now I got an echo. All right, how about this? That should give us audio now. Hello, everybody. Yeah, give me 1 second. I'm fixing it. Super strange. I'm getting 2 audio inputs now, which is also very weird. How about that? Nope, still audio. There we go. I know, Matt. I'm working on it, brother. Okay, let's see what I can fix. All right, let's see here. Pulling an echo in from someplace. All right, how you guys hearing an echo on your end, or is that just on my end? All right, good. Okay. Well, we're going to run with it as it is now. I'll fix the audio later. As long as you guys can hear me, let's just hear, let's see here. Okay, I got the audio up. All right, perfect. We're just going to roll with that. Let me change one little feature on my end, and we will hop into what I promise will not be a bad show. Let's see here. Vertical layout, audio, advanced properties. I'm just going to change one thing here. There we go. No echo on LinkedIn. All right, Jason, let's get into it, everybody. We got a long show, and I wasted enough time trying to figure out logistics. I apologize in advance. Some of the stuff I wanted to work with did not go according to plan. So, because this is the live show, and I'm going to switch over here to this camera here, we have a couple different things we got to get into right out of the way, right in the beginning. So you have, any of you watching, the chat is enabled. You'll be able to see that right over on that side there. I will be monitoring that throughout the entire show. That being said, we are going to do some light chart work in this episode, so you will see things like me drawing on this like that. Hopefully you guys can see that. There you go. Perfect. So you will see that happening throughout time to time in the show. So if you are watching on a vertical platform, you will not see quite the same, I guess, immersive experience that you get from this platform on a wide kind of shot. So think LinkedIn, think X, think YouTube. Should be a better stream production there. We do have some new toys to get into, but we will play with a lot of those later. Let's first jump in to kind of the context of what we're going to talk about today. This is not a market hour show. This is going to be more of a macro detail show. For those of you who listened to the Higher Standard podcast before, this is going to be a little bit different. We're going to spend a little bit of time being more educational, more thoughtful, in a little bit more detail, but we're also going to react to some stuff in real time. For example, Tesla had some interesting news that came out today. But first, let's talk about inflation. Since 2019 till now, one of the things we talked a lot about on the show is how we know that inflation has impacted us all a lot differently. And what we can say is that we know that earnings haven't kept up. So we're looking at asset inflation as a big problem in the market, and we're going to spend some time looking at charts like this chart here. This chart shows you consumer price categories with the most inflation since the pandemic. Percentage change in the U.S. consumer price since November 2019 until now. Now, that in and of itself is a pretty wide time, but when you think about the context that most of us getting about 3% cost of living salary adjustment increases on a year-to-year basis, that is not a huge lift for a lot of American salaries, particularly when you think about this in the context of things like motor vehicle insurance. That is a pretty crazy number. And I'm going to put that there. There you go. That's a pretty crazy number increase, 56.1% increase. And that in and of itself probably wouldn't be enough to sink most Americans. But when you start looking at this in the context of utilities, we're all paying that. We're all paying motor vehicle insurance. We all have motor vehicle repair and maintenance. Coffee, 46.1%. Electricity, again, utilities, 40.4%. Meats, poultry. A lot of these things are things that Americans are in fact paying every single day. So when you see that macro inflation number, that headline figure of inflation being somewhere in the neighborhood of, call it 2.7% or 2.4%. That's an average of things. But the sad part is most Americans are averaging these figures here over the last 6 years, not the figures that you see reported on the mainstream media, and that can be problematic. So let's spend a little bit of time going into a different view here. All of these links, if you're on YouTube, they're in the show notes already. I'm going to add some more that I picked up just before the show. And I should also point out the ticker you're seeing below me is in real time. So if you want to watch the markets, you typically do that with CNBC. You can also do that with us here. We are monitoring that in real time as well. Regil is in the background. You may hear him from time to time yelling at me because he's supposed to keep me on track. Hey, there he is. Affordability is a buzzword right now. These charts show why, according to CNBC, a questionable logo redesign. This chart I thought was really interesting, and I'm going to spend some time here as well. Inflation in the U.S. since the pandemic, all items, the average figure here, again, right there, 24% all items from 2019 to now. So certainly a very low number relative to things like this, motor vehicle insurance. Look at that line. Look at how significantly different that increase is relative to the average category. If you look at it in the perspective of this orange line, that's double, man. So you wonder why Americans are feeling the pinch. And I promise you, this will all come back to be kind of a resounding theme towards the end of the episode. But right now, we want to spend some time kind of setting this foundation first and then jumping into things a little later on. Somebody did ask in the comments what the streaming bar is above the stock market ticker. That is Polymarket's predictability markets or predictable markets. They're going to give you kind of predictions on what they think will or will not happen based on bets. If you're not familiar with Polymarket, that is an open API source coming straight from their website. You can go there. We've configured this in such a way that, you know, red is not likely to happen, orange is slightly more likely to happen, yellow is probably close to 50%. Anything green and above, you're looking at a high probability, usually 76% or above probability of will happening. We threw in some sports stuff here as well as some pop culture, but it is predominantly finance related. So going back to the CNBC article, you can see again the same chart that we cited earlier, that inflation is a meaningful problem that we're all facing. And the question that everybody has for 2026 is how is this going to impact me? What does this mean for my personal wallet? And we're going to address that today. In particular, we're going to talk about the psychological tax of inflation on everybody, the shrinkflation, if you will. Expectations need to reset moving forward because there is a fundamental problem with wages that have compounded this issue as it relates to inflation, and that is on this chart here. This chart here is the lowest wage workers had the strongest growth during the pandemic, and that's interesting because I think one of the things we keep hearing about is a shrinking middle class. And what that really essentially means is that there's an asset economy, people who have a lot of assets, the wealthy, and those who don't have a lot of assets. And the largest amount of growth that we've seen seems to have come from the category here on the left. This is the lowest 10% of wage earners have had the most growth, but everybody else has fallen into this bucket here. And that's really interesting when you think about it in the context. And let me just highlight this a little differently because Daddy's got snazzy tools now. So what we're going to do is let's focus on this category here. That's your middle class. If the middle class isn't getting the same amount of wage increase as, and I'm not advocating that they should, I'm just saying this is what shrinks out the middle class. You're having a fundamental problem with wages that are not keeping up with inflation for what traditionally used to be defined as the middle class. That isn't to say that this lower 10 percentile isn't hurting as well. A significant increase of 13.2% in this case from 2019 to 2023, and granted it's a little dated, isn't going to make them, because let's say you have a $50,000 salary, 13% increase, not the same thing as if you had a $200,000 salary and got a 2% increase. So let's not forget that there's real dollars behind this. What we're doing is setting up a problem here. Now, it's easy to point at this and say, well, the high wage earners, the 90th percentile, they got a 4.4% increase on average. And what I would say to that is that the uber wealthy don't report earnings and income and wages like you and I do. They generally have assets, those assets pay them, and they can write those earnings off against their expense load, and they have very different tax accounting strategies so that this number is not really indicative of their overall financial health. This chart is really meant to say one thing very clearly to us, that wages have not kept up with significant inflation. And granted, we're 2 years short here based on the previous chart, but let's just do a little side-by-side look here just to show one more comparison. So here you have the two charts side by side. You've got consumer price categories from CNBC. Again, this is to 2025 versus this to 2023. There wasn't anything I could find that was more up to date. You've got a problem. And this clearly shows that wages have not kept up with inflation. And I'm going to show you today how this problem is going to get worse before it gets better. And not because anyone's being malicious or anybody's being, I guess, unfair or inequitable. What's really happening here is that you're seeing the byproduct of AI and technology coming to pass in a way that people are ignoring. And they're saying things, and you heard Jerome Powell recently say, we're not seeing it in the jobs reports. I will beg to differ, and I will show you that that is not the case coming up here in a little bit of this. Before I do that, let's go to the chat for a little bit here. Let's go back here and go to the chat. I have any comments, suggestions, concerns? No echo. Thank you, Sean. Anybody have any thoughts that we've seen so far before we move on to the next piece? This will get pretty detailed and this will get pretty in depth. So if anybody has any thoughts, comments, suggestions, now is the time. Why does everyone I know have side gigs? Okay, yeah, let's address that one, Sean. So everyone you know has side hustles because they can't afford it. I mean, that's the bottom line here. But let me show you some new tech we got going on here. Said and I are really proud about this. Regil and I almost peed ourselves when we first started playing with it. But we can do things like this now. There you go. Why does everyone I know have side gigs? Everyone we know, including ourselves, have side gigs. And the reason why is because of this. If you have a standard of living and you're supposed to keep up with that standard of living, the last thing we want to do as humans is cut back because we feel like our performance has grown and continued to do well. So we inherently, as humans, don't want to stop keeping our lifestyle where it is. So if you've been performing at work, you've been doing the things you're supposed to be doing, and you say to yourself, well, hey, I don't feel like I can afford to do X, Y, and Z anymore. You say to yourself, well, how is that fair? So you get a side job instead of pulling back on what you feel is your basic standard of care. Fair or not, that's kind of where most humans wind up. I will also say that there's this weird stigma to people having extra sources of income as employees. And I'll be on record here, and then people have heard me say this throughout my life, that having a side hustle should not be something that is governed by your primary job unless it is a conflict or you are unable to competently do your job. In some cases, you get penalized for being open or public about this. A lot of people will sell homes on the side, for example, as a realtor for their friends and family. And then there are people at work say, well, you're not paying attention to it. The irony is most uber successful entrepreneurs that you know, think Jamie Dimon, think Elon Musk, they always have their hands in different pots. And it would not be a surprise to anybody to say that those people have more of an entrepreneurial mindset. And as a result of that entrepreneurial mindset, they continue to try to push to try to build more revenue in other places and build more things. They are builders. Yet we as employees tend to get penalized for that. And I would say that that's probably hypocritical at best and wrong in most cases. Now, social media usage, I'm on social media a lot, might be different, but let's talk about 2026 inflation and market predictions. The number one question that we get asked on the show is affordability in the home market going to improve? And I think the short answer is not really. And I know that's going to offend some people here because it sounds kind of ominous. But what I'm trying to do is, and let me go back to the host plus screen view here. What I'm trying to do is give you guys a little bit of a perspective that's real and straightforward. If you guys have any challenging perspectives or thoughts on this to the contrary, by all means, please jump in and say so. But I don't think that you're going to see housing affordability move significantly in 2026. About 7 in 10 Americans polled by CBS News in December said that they were struggling to pay for food, just food. Housing and healthcare underscore the affordability issues as well, affecting millions of households. Inflation should cool to about 2.4% in 2026 if you're believing the Fed. And according to December's forecast from the Federal Reserve, that's where they want to see it, and that's where they expect to see it. But what we would still leave inflation well above the central bank's goal, which if you've been following the show for any length of time is about 2%. Signaling higher inflation will continue to weigh on families' finances for the next year. William Blair, economist, said that in a report that I'm reading to you a little bit here. About 1/3 of Americans think their finances are likely to worsen in the year ahead, primarily driven by, of course, inflation, because you've seen that inflation and wages have not worked in conjunction. So the question then becomes, well, what will the motivation be to have I guess, you know what? I'll show this later. Let's go. Let's go to the teleprompter here for a second. What will the motivation be for most Americans in their jobs to get more money? Is the company going to pay them more? Or are they going to say, okay, I have to make more money on the side as a side hustle? How are most Americans going to get more money? Sure, you can get promotions. That's one way to do it. You can do a couple different things. Let's go to the chat here while I have this on. There's a couple different variants with which this happens, and for most people, a promotion isn't possible. Why? People are living longer, staying in their jobs longer. They're not moving from one job to another job. And you have, of course, rising unemployment, which went from 4.3%, 4.4% now. It's been going up incrementally. And people say, well, you know, this is just seasonal or it's not really AI. But there's a certain amount of healthy transitory migration from job to job that is normal. And 5% used to be that moniker. And now I think 4.5% is more of the Fed's target. But what's going to significantly move the needle to get American wages back up to a point where they feel like they did in 2019? And I don't know that I have an answer to that, but I have some tertiary facts we're going to cover here that I think are important. And I think what's also worthwhile is that we spend some time looking at the S&P's performance. If you follow the show, again, you know some of the things we've talked about in the S&P are really interesting. Like, for example, is it keeping up? The long-term performance of housing versus the S&P. This is an interesting chart. I think this is surprising for most people. Volume what? Volume up a bit. Okay. Tell me if that's better. So the S&P 500 long-term performance versus housing from 1971 to 2025 is exhibited on this chart. And if you are watching this closely and you've been already aware of this, then I apologize. But this was shocking to me to see that divide. I have long been a proponent in investing in real estate. So to see that the long-term investments in the S&P 500 have outperformed housing so significantly as this chart seems to suggest, well, that to me was a bit of a surprise. And it goes to show an interesting concept that really hasn't been kind of talked about in a material way. The majority of Americans derive their highest amount of net worth from the equity they build in their homes over time. And most Americans, predominantly the middle class, relied on this to build their net worth. And historically speaking, the overwhelming majority of Americans did not have a ton of money to put into the S&P 500. It's always been something they suggested that we do. It's always been something that they say you do. There was a 60-40 split of equities and bonds. People should invest in this space. But most Americans found their wealth from their house. And more Americans today are unable to buy homes. So this in and of itself does not mean that we're going to have as big of a gap as we once expected, at least on the show, to see between the middle class. There is hope here in that if we can have performance gains in the stock market similar to what we see in home equity appreciation over time, that there is a hope for younger Americans today who are unable to buy a home, who can begin to invest in the markets and can begin to grow their portfolios. So I don't know if there's necessarily a bad thing to say here as much as it's just a thing that's surprising to me, at least. I've never seen it drawn this way, and I thought it was worthwhile to share. And while I leave this up here, I'm going to talk about some other details that I think are important. So will the Federal Reserve continue to cut rates? We know that they will. The Federal Reserve will cut again in 2026. How much remains to be seen, but their dual mandate will become challenged. One of the things you're seeing on this chart is a bit of a concerning change in dynamic of the way that Americans are going to invest moving forward. We know that most Americans cannot buy a home. And if they cannot buy a home, then they're going to have to look for alternative investments. Some of the investments we talked about on the show, getting away from traditional investment strategy of 60-40 has been maybe we go into the QQQ, the top 100 stocks in the NASDAQ, which is more tech focused. Maybe that is a better solution long term. When you look at the S&P 500's performance, that's been good relative to housing. But what if I told you there was a way to outperform that based on what we've seen for the last several years? Of course, the logical question is Chris, well, is there a bubble pushing that? And the answer is, maybe. But that isn't necessarily a bad thing, and we'll get into that shortly. So as far as housing, will it become more affordable in the next year? There'll be incremental improvements in certain key markets, but on the macro affordability level across the country, nationwide, you're not going to see dynamic improvement. And I think that's because mortgage rates are likely to hover in the low 6%. I don't see a tremendous amount of inventory coming on the market. And I have been traditionally a little bit of a bear in some cases when it comes to the housing market. I know there's pundits on both sides of the aisle talking about how broken the housing market is. I'm not here to argue it. I'm just here to say that I don't think that there's going to be a huge increase in affordability this year. I think it's going to be a slower, longer, painful correction. And I use the word correction technically, not loosely. I don't think you're going to see a market crash. And if anybody's going to tell me, hey, Chris, the market's going to crash, I would argue, what is that catalyst? A lot of times people will say, well, the stock market's super high, Chris. There's all these stocks that are leading the way. The housing market's overvalued. I agree on all of these things. These are very factual. What I'm going to ask everybody in return, though, is what is that market catalyst? And let's go to the chat here for a little bit and see if anybody has any thoughts as to what that market catalyst could be. Do I think will happen if and when the Fed chair changes, somebody aligns more aggressively? So that's actually an interesting question. Let's cover that one a little bit more in detail, because I do think that is something that we're going to have to spend some time acknowledging as a society. You've got a very different climate coming up that I don't think that everybody is ready for. So to share this with everybody here, what do you think will happen if when the Fed chair changes to someone who aligns with more aggressive cuts? We've seen Myron come out and clearly want more aggressive rate cuts, and he has been the vocal voice of dissent in all the FOMC meetings since he's been named. It is no surprise to any that Jerome Powell will be out at the end of his term. I want to say it's in May of 2026. So he is going to stay on the FOMC, which is why you've seen the increased pressure by the president to say that he should resign, because the president really wants him to resign. So he has Myron, a new FOMC chair, and then a third voting person who will likely vote as aggressively as Myron, which would, as this comment suggests, materially change the focus and the voting position of the FOMC. Because as of right now, we saw in the last FOMC minutes that the FOMC was leaning much more conservatively than we felt after the announcement where they last cut rates. So I think there's something to be said for there being a very different economic climate. But what I would say to that is you have to understand that the mortgage market is largely influenced by the longer-term treasuries, in particular, the correlation between the 10-year treasury and the 30-year mortgage market. I don't see the Fed cutting rates aggressively really changing that 10-year treasury outlook. As a matter of fact, during the last FOMC cut, we saw the treasuries react a little differently. We saw mortgage rates rise. Maybe it's because it was the last rate cut of the year, maybe because they knew it was the end of the cutting cycle. But what traditionally happens in the market is the bankers and the people in the space will tend to react ahead of it and forecast in what they think is going to happen before a rate cut. So you'll see mortgage rates dip before they believe an actual mortgage rate goes down. It's just their way of capturing the business, and it's a huge parasitic systematic thing. I don't know that you're going to see that level of decrease long-term in the 10-year. I think it's going to hover around 6%. Again, this is not a bad thing. I think a lot of people freak out about, oh, we're not getting the 2 to 3% rates again. 2 to 3% rates is not healthy. We had 14, 15 years of artificial interest rate deflation, and keeping rates that artificially low is not wise. And I don't think it's good long-term, because what happens if rates go down, right? You get home values, they're going to go up. It's as simple as that. Now, let's just say you don't do the right thing. Let's just say you add in a 50-year mortgage, right? If you add in a 50-year mortgage, it's effective the same as rates going down. Home values will go up. There is an inventory problem here that pricing in and of itself will not fix. So unless somebody can point to a particular catalyst which is going to change these dynamics, we wind up in a situation where I say, okay, it's going to be a slow, prolonged correction. People can't afford to buy. They're window shopping for homes. It's the down payment. It's the monthly payments. It's a Molotov cocktail of problems. So until such time as they actually can buy, you're going to see the mortgage market slow down in a lot of major metropolitan areas. And I think you might see kind of an anticlimactic year. We're already starting to see, I think for the first time, 53% of properties across the country having lower values, decreasing values as reported to Zillow or Redfin. If Saeed were here, he'd correct me. He's a data guy. I'm just here to look pretty. So the next question, will the jobs market improve? Sadly, on this one, I'm going to take a pretty aggressive stance. I do not think that it will materially improve. And because I don't think that the jobs market is going to materially improve, I think there's a bigger issue here. And let's spend some time on this, because I think that the bigger issue as it relates to the job market is we are seeing a world where efficiency is improving at companies. You can blame that on AI, you can blame it on a lot of different things, but efficiency is in fact improving. And what we're going to go through here shortly is an example of how this efficiency and the growth of things like tech companies are going to, and already are, impacting the jobs market. So I think we're heading into, and I don't have a spoiler alert here, what could and likely will be the first time in modern history that we're seeing a decoupling of the Fed's dual mandate. It used to be jobs and employment, right? I'm sorry, jobs and prices, stable prices and stable jobs economy, right? And usually that was about 2% inflation per year and about 5%. And those numbers have changed. I think traditionally, if you kept inflation around 3%, it'd probably be fine by most people's standards, but there's been a bit of a conservative nature as it relates to that. So let's get back into the main part of the show. I'm going to go back to the desk here. Anecdotally, if you guys are on different platforms and you're seeing other comments come through, there is a bot working to pull comments from different platforms into different places. So depending on where you are, you may or may not see some of that come through. And then, a little fun fact, while we're mid-show, I can also show you some stuff. If there is anything that comes up during the show, I could always ping you here and go to like a market update segment here. Or if something, breaking comes through, like for example, Saeed were to walk in, I could go to a breaking news segment like this. But for this particular show, there isn't anything super exhilarating. It's just me talking to you for a little bit of time. So of course, the last question, I think, as far as the prediction goes for 2026, are the stocks in a bubble? There's a stock market in a bubble right now, and I would say we have a very fractured market. We will speak at length about this during the rest of this show, but I do believe there is a stock market bubble and we are in one. I do not think that is a reason to panic. Frankly, this is an earnings-based bubble as much as it is a revolutionary technology bubble, and that is where we're going to unpack a lot of this. Overall, forecasters expect a strong stock market performance in 2026. JP Morgan, for example, in November forecasted the S&P 500 will rise 13 to 15% next year, roughly in line with the index's average gain over the last decade. S&P returns by year, for those of you who are interested, 2019, S&P returned 31.2%. 2020, 18%. 2021, 28.5%. 2022, 18% down. Obviously, that was an interesting, unique year. But in 2023, it rebounded at plus 26.1%, 24, 24.9%. In 2025, the S&P returns were 19.4%. There are very few markets in which you see something like that happening in the housing market. And yeah, we just lived through an interesting time. There's going to be somebody who's like, Chris, I saw that in the housing market. Yeah, I agree. This, according to Compass, is your home price change year over year via Case-Shiller Index National Home Price Information. And I would like to point out, you're seeing a trend here. Atlanta, down. Boston, down. Charlotte, down. Chicago, maybe flat. But all of these are down. Miami, Los Angeles, down, down, down. The interesting one, the one that caught my eye, and I was like, wait a minute, what's going on here? San Francisco, kids, starting to peak back up. Regil, you happy about that? He's not happy about that. Yeah, long story short, San Francisco seems to be the only one to peak back up. And let's hone in on this here. Nationally, from October 24 to October 25, that ain't going up, kids. That's going down. How many of you are really surprised by that? So, excuse me, that was a bit more coffee than I wanted. All right, so we know that the housing market's continuing to go down now. We know the S&P has historically outperformed this. So I guess the question then remains, what does that mean for how you should invest and what you should expect in 2026? So to recap, before we get into some deal-making history and what I think are some useful charts and some analytics, I don't think the affordability in the housing market is going to improve. 7 in 10 Americans are concerned. A lot of Americans are worried about inflation. The Federal Reserve will continue to cut interest rates at least once throughout the year, if not more. Who knows what happens if Jerome Powell is out, but I think you're going to see at least one cut, if not more. Will housing become more affordable? I don't think so, without some aggressive stance by the Fed, and that would cause all sorts of reverberating effects. Will the job markets improve? No, I do not. And are we in a bubble? Yes, but don't panic, and I'm going to tell you why. Okay, so let's jump into the Kobisi letter. For those of you who know us on the primary show, I like to follow several different websites, and the Kobisi letter is a great example. Sorry about that. Let's go here of this. This is from the Kobisi letter. Deal making, AI deal making is at a history. U.S. startups have raised about $150 billion in funding year to date, set for the third consecutive annual increase. This sits $58 billion above the 2021 record. The largest among these transactions was a $41 billion capital raise by OpenAI, backed by SoftBank, of course, a name we all know, followed by a $13 billion funding round for Anthropic completed in September. I'm a big fan of Anthropic and what I'm seeing out of them lately. I think they've done a lot with a lot less spend, frankly. It's kind of hard to see that when you're talking 41 versus 13 billion, but trust me when I say less spend. This also includes a $14 billion strategic investment by Meta into data labeling firm Scale AI. Other rapidly scaling AI companies, including a company I can't say, Perplexity, Thinking Lab Machines, also raised capital for venture investors multiple times this year. The AI investment boom of 2025 has been historic. And let's switch to the big screen so we can go over how historic that actually was. Here you go. This goes to show you the larger successful startups have raised more than ever. This is money pouring into AI. And someone's going to say, well, Chris, that's a bubble, right? Like that's what this is. This is a bubble, right, dude? And I would say, yeah, it likely is a bubble, but that does not necessarily mean it's going to pop. It just means that people believe this is the future. And I would ask many of you, how many of you actually use AI frequently? So let's go to the comments here. How many people of you watching the show actually use AI on a regular basis? I think a lot of you people do. And let's just see. I haven't responded to anybody. Hello, everyone. There you go. All my friends, it's interesting that there's a ton more houses in the market, but they're definitely not moving fast or moving all. Yeah, I think that's probably going to be a recurring trend. I think the market's going to slow down. I think people are emotionally exhausted. And if you look at the spending habits and the need to have second jobs, a lot of people are saying, okay, yeah, I want to buy a house, but do I really want to have to work this hard all the time? That kind of pressure on my back. It can be kind of overwhelming. Matt, 20 to 30 times a day. That sounds about right. So yeah, people use it, and I use it a lot. I actually recently started using Claude a lot more for coding. Wow, if you guys are in ChatGPT's camp, take a look at Claude. It is different, but it is really, really cool. We do with some of our systems. Interesting, Sean. By the way, Sean, first comment of the day. Thank you very much for that. It makes me feel all warm and fuzzy on the inside every time I see your name pop up. Let's dive into the next chart. I think there's a lot of really good information here, which is going to round out a little bit of this particular perspective before we jump into the next thing. So we have the deal-making history here. Now let's talk about how the AI bubble compares historically, because that is the next logical question. I'm going to bring up a chart here from the Financial Times. Here it is. This shows you the U.S. stock market has surged relative to GDP and valuations are near their dot-com peak. And of course, everybody, every time they talk about AI, loves to bring up the dot-com bubbles. I get it. I understand where they're coming from and why. But here you have the Wall Street crash, 1929. Here you have the dot-com bubble. And approaching this right now is, in fact, that line there. That is presumably the AI bubble that we find ourselves in. U.S. market cap as a share of GDP, not cyclically adjusted below, is very similar. That's down here below. I would say both these charts effectively point out the same thing. They just really try to poke at the people who have questions as to one data point versus another being more valuable. So not a whole lot there to worry about. But what I will say is, yeah, you've got a market which has a stock market surging. Okay? That is bad if AI does not do what its value proposition says that it's going to do. If it does not produce more efficient companies and more returns, then you're going to have a problem. So all of these companies, every single one of them that says AI on an earnings call has a reason to be more efficient, and efficiency is a function of how much money they make. How much money they make relative to how expensive their worlds are. That is effectively their efficiency. You can add in some employee factors there. So because of that, that does put FTE, full-time employment, and how many people they're employing to get that level of efficiency under the microscope and magnified greatly for concern and watch by everybody. And when you have something that's being watched to that degree by everyone, because everybody and their mother brought up earnings calls, that means they're going to have to lean on the technology and pull back from the human element, which is going to impact jobs. The surge in AI stocks has followed trends of previous technologies such as railways and the internet. I thought the railway comparison was really interesting here. That's this chart here on the left from the Financial Times. And it goes to compare the current dot-com era to the railway mania in the UK, the dot-com bubble, and the S&P, which is going to be a bit of our conversation point here, and the AI boom, S&P 500 markets here. Very similar patterns. Again, I don't know that these are necessarily equal and equivalent to say that any of these things should be, I guess, immediately concerning, if you will. The railway media, well, railways fundamentally changed how we got food and supplies and how we moved around as an economy, and it stayed elevated for quite some time. I think that mania was valuable because it changed things, almost like transatlantic flight did. I mean, frankly, for those of you on the West Coast, this is probably a good example. Before Hawaii was something that people could get to with transatlantic flight, everybody took their time and went to Catalina Island. And now that Catalina Island is no longer, as the only hard place to get to, everybody goes to Hawaii, and that island got overlooked. Things change. That's time. That's technology. But do we still rely on railways? Yes, we do. The dot-com bubble, yeah, there was a lot of companies in the dot-com bubble who weren't making money. But earnings are going to be the differentiator here, and we're going to get into that here in a little bit. Earnings are really, really important, and they're going to differentiate a lot of what we see and a lot of what we think is happening in the business world. So I think the problem for a lot of people who say this is a dot-com thing, it's a bubble, it's going to burst. I think the issue you have here is that I just figured out what my headphones are doing while they're echoing. Look at that. Halfway into the show, baby. All right, so the earnings issue here is going to be the biggest problem, and the earnings do support AI. Yes, they got a ton of money they're going to spend. There's a whole infrastructure issue, but for right now, this is supported by earnings on some level versus this window of time where earnings did not support it. It was all speculative. And that speculative nature of investments is fine for venture capital, but not for your money in the stock market. And unfortunately, that's the problem with the hype train. So let's get into the next piece here. I think you guys are going to find this interesting. I think the key predictions in this market are going to be fewer winners, more concentration, and efficiency beats expansion. Okay, that's going to be common themes. Before I jump into some AI commentary from one of my favorites, Ray Dalio, does anybody have anything in the chat they want to talk about? I'm going to pull the chat up here in a moment. I'm still getting used to reading this versus that. There's actually a chat screen on my screen, which is a little bit more legible than this. But what do you guys think? Is this something you guys like seeing on the live? I mean, I know depending on what platform you're in, you can see it in different formats. The whole concept, the idea of the show was to bring everybody in and to think about like ESPN, think of Jim Cramer, think traditional media, but for a world where we can do something as simple as scrolling social media in real time. So the idea is to improve and to share a little bit more commonly. So I guess if you don't like it, let me know. Otherwise, I'm going to jump back into some stuff I want to share with you. Let's go back into the widescreen here format. We're going to show a little bit, and the audio here is going to be a bit tricky for me. So I apologize in advance. I'm still trying to figure out the best way to measure audio. Here we go. This is Ray Dalio on his thoughts of artificial intelligence and the bubble fears, obviously courtesy of CNBC. This is a bit old, but I think it's still very much valuable. All right, let's jump into it. No audio, really? Oh, pause that. Are you guys not hearing that out there? Let's see here. Let's check the chat. You guys hearing that at all? Only the sound of me can pop. I can't pop. That's a common problem. No sound on the audio. Okay. Well, here's essentially what Ray Dalio is saying: is that there is no way to tell that a bubble is about to pop, and that values can and will go up a great deal. And because of that, and let me see, I can fix the audio here. I believe that I can. But because of that, you wind up in a situation where you don't know what's going to happen with our ecosystems. You don't know what's going to pop a bubble, and you don't know how far up it can go. Ray actually goes on to say that in his experience, and again, this is one of the best investors in modern history. Obviously, you got Warren Buffett, who just retired, and he's another fantastic investor, and they have very different perspectives on this. But I would say that you've got a pretty significant market here. And he's trying to suggest that until such time as you find something that's a catalyst to pop this bubble, that the market can and will go up a great deal. And until such time as there's something that comes around and shows threats to that, for example, AI not living up to a lot of the hype, you're going to wind up seeing the market continue to grow. And I think that that's a fair assessment, particularly when you've got earnings backing a lot of things. I apologize for some of the technical challenges here with some of the audio. What I'm trying to work through here in the background is audio coming in through a Rodecaster audio interface into this here. And it's interesting to see that some of the stuff is not porting over from the computer, which is all what we're using to stream everything anyway. But I will figure it out. Don't worry. So let's take a bit of a time to reset here. I have a whole segment on Warren Buffett, which I think is a valuable segment to cover. Warren is, I guess Ray Dalio is only for Chris. Funny. That's funny. So I think that the problem that we're seeing with AI hype, inflation, is that no one in this market can sufficiently tell us, besides they're afraid, how these things correct. And for those of you who go on to TikTok or LinkedIn or X, all the places this show streams, and you go to these channels and you try to listen to people and find a good resource for someone to tell you what's going to happen next, you get a lot of people giving you their fears. And giving you their fears does not mean they understand what the catalyst will be. A great example of this, and I've done this before myself, so I'm not criticizing anybody other than myself, but is they'll say, well, this can't last. You know, affordability in the housing market is terrible, so because of that, you're not going to be able to see home values continue to increase. And yet they do time and time again. Well, again, this is because nobody has a reason for why that would not continue to increase. So fear is an important thing. I think it's rational to be afraid of what we're seeing in the markets. It's rational to be afraid of the housing markets and the entire middle class being shrunken by what we're seeing here. But again, there are no facts with which to support that. And there are lots of things that could happen between now and, frankly, a correction that could set things on fire. You've got an FOMC, which is changing its landscape pretty dynamically in this upcoming year. You've got already talks of things like a 50-year mortgage coming out, which we do not support and we're not fans of on the show, but that's something that could happen. And if it does happen, it's going to change the landscape of housing yet again. So all I can tell you is be prepared, be thoughtful, and be patient, because you don't know what's going to come next. And until we can actually point to something that is underperforming, that is going to cause people to materially not do things, I think that it's going to be a slow correction at best. So let's talk about your boy Warren Buffett. Buffett is a contrast on modern markets. Buffett has always had a long-term discipline. Warren Buffett has always been about staying in the markets. He just retired, for those of you who don't know, on Friday. Last week he retired. Maybe I'm wrong there. I'll double check that. But basically, he's hated Bitcoin for the entirety of his time because it doesn't have any value other than people speculating. And he never liked speculation. He thought speculative values not backed by anything, particularly assets, was problematic. And this was a theme that he shared over and over again throughout his career. He oftentimes liked the idea of looking at balance sheets versus income statements because he felt that there was less funny accounting business. And as somebody who's been in the publicly publicly traded company world, I can tell you there is less funny business on a balance sheet than there is on an income statement. There's lots of things you can do to change the way income looks, tax benefits and whatnot. But a balance sheet is almost pure in some cases. And he loved assets. So it should come as no surprise that Warren Buffett, a man who has been in his position investing for 60 years, who relied heavily on very fundamental concepts. You know, he gave interviews in 1963, one of which I wanted to share with you guys today, but due to the audio problem, I don't want to risk it. But I think it's safe to say that his perspective was based on a different time. And I don't mean that to knock a man who is going to be known as the greatest investor of all time, if he isn't already known as that, for the next 100 years for sure. I think that that's a meaningful thing, and it's important to understand. But I do think that if you're going to invest the way Warren Buffett did, you have a problem that the younger demographic continues to vocalize, and that is they don't want to be rich when they're 80 years old. Warren Buffett was not worth what he's worth now 60 years ago. He took a long time to build that. Now, yeah, he was worth a couple million and he put some money, but the only reason that he accumulated billions of dollars the way that he did is because he kept that money in the markets and lived a very conservative lifestyle. That conservative lifestyle meant living in the same house and enjoying things like McDonald's and being uber conservative with his finances. And I would say that most people don't want to do that. They want to enjoy the fruits of their labor. So his way of investing isn't appealing to most Americans. Then on the other side of the spectrum, you have someone like a Dave Ramsey, who does give advice that says everybody can do what I'm telling you to do and live a happier life. The problem with his advice is, he says, I can't make you more money. I can just teach you how to spend less. So don't go buy the cup of coffee. Don't take on credit card debt. Don't live a life beyond your means. The problem is that ignores the fundamental human connection that once made middle America what it is today. And that is very simple. You wanted to keep up with the Joneses next door. And traditionally, for a long part of American history, you could do that. If you worked a blue-collar job or a white-collar job and your neighbors worked similar jobs because they lived in the same neighborhood, you could all generally afford the same things. Well, now people can't afford the same things, and the ability to buy things is shrinking, as we saw at the top of the show. And because of that, you wind up in a scenario with which people are feeling discouraged. And if they're feeling discouraged, that old school way of investing reminds people to be skeptical of not only what worked for other people, but they want to live life and they want to live a higher quality of life. And the easiest thing to point to and say is, look, Warren Buffett lived a great life. And he's still alive. Charlie Munger, may he rest in peace, is not. And people would say, did they live extravagant lives? Did they enjoy their wealth? And I think by most people's standards, the idea of enjoying wealth by being comfortable is not enough anymore. Demonize that if you will. I've been a conservative person my entire investing life, but I question that at moments like this. And Warren Buffett's retirement really brought that home for me. His first interview was 63 years ago. And in that interview, he explains the critical difference between investing and speculating. And then he comes back in a recent interview not too long ago where he talks about that Bitcoin doesn't produce anything. If the asset like Bitcoin doesn't produce anything, you're just hoping for the greater fool. That was both he and Charlie Munger's thought process. Real investing, as he put it, was always about the output of the asset itself, which kind of echoes a lot of people that you're seeing to buy something that makes something, build something, sell something. I like multifamily apartment buildings, so it makes sense that you would invest in that because it produces income for you on a monthly basis. It also has the equity upside appreciation. But there's a whole entire cohort of listeners to our show who love to buy businesses, one of which is really into doggy daycare businesses, and he looks to buy those pretty frequently when they come up. And look, there's nothing wrong with that. That asset produces something. His argument here is, other than appreciation of selling Bitcoin to someone else when you need it, what does it produce? The problem for most younger people is they would look at currency, the US dollar, fiat currency, and say, what the hell does this produce? Matter of fact, it used to be backed by gold, and we went off the gold standard. And if we went off the gold standards, what's the difference between Bitcoin and cryptocurrency other than the greater fool is foreign countries buying our bonds based on US currency? So I don't know that logic that Warren Buffett, great, way better investor than me, grain of salt, I don't know that logic that made him the billions that he made today is appealing to most Americans, albeit still very valid. You're never going to get outsized returns following a very conservative investing methodology unless you're in the game for a long time. And that's where the delta is with most people's investment methodology. So we covered this on a previous show, but I think it's important to cover now. Tech leadership and the death of the 60-40 split. So our prior thesis on the show was that earnings are not evenly distributed anymore. And I'm going to explain this with some chart work ahead. If you're bored of hearing me talk, I'm sorry in advance. But if we used to say go into 60% stock market equities, 40% bonds, and that'll get you wealthy over time, and that'll make you rich. I don't know that we can say that anymore. I don't know that that split still makes sense, because if you look at the market as a whole and you say you got 60% in stocks, but stocks for the most part aren't performing, right? And bonds, well, bonds aren't what they used to be. The bond market's been wonky. Then maybe this is not the way to go anymore, and maybe you go to something like the QQQ, right? Or maybe you stop investing in the indexes because that's the easy way out. Like it or not, Warren Buffett's famous bet where he told people that he was going to invest in a low-cost index fund and sit it there is going to outperform a money manager. It was right. It did teach us meaningful things. But it does not seem to be as valuable to most Americans today, because here's the problem. Okay, problem number one is, yes, low-cost index funds do outperform, right? Low-cost index funds do outperform the market. And a money manager, right, generally is not going to outperform that over time. But a good money manager can and will. Warren Buffett was one of those. Okay? And maybe this is not appealing to you because you want a money manager. Maybe it's appealing to you because you want somebody just to focus on it so you don't have to. But the problem with low-cost index funds is you're taking the average return of the market effectively and baking it in, and then you're paying a fee. There needs to be a way to get more returns to take advantage of that chart that I showed you of the S&P growth versus housing, so that you can get bigger returns today and not be discouraged. And I think that there is a way to do that, and I think we should talk about that, because 2026 is going to prove this theory out. So the earnings reality we have to talk about is Mag 7 versus the rest. The 2025 rally was earnings driven, not just hype driven. The Mag 7, 26% year over year earnings driven return, earnings growth. The other 493 stocks in the Mag 7 were up only 4%. Only 4%. I'm going to go back to the Kobisi letter here. I think it's got a valuable look. Let's go to the social perspective. I'll make this nice and big. There you go. Earnings increasingly driving the market rally. The contribution of earnings growth in the S&P 500 returns is up 79% year to date in 2025, on track for the second consecutive annual increase. Earnings contribution has increased plus 24 points year over year and has nearly tripled since 2023. Wow. As a result, the remaining 21% year to date has come from multiple expansions reflecting higher market valuations. By comparison, multiple expansions made up 45% and 73% of market gains in the last year and in 2023. Put differently, the quality of market momentum is improving. Fundamentals are strong. So if we are in an AI bubble, and the Mag 7 is leading the way, okay? But you've got something like earnings growth increasing and multiple expansion. I would say, okay, well then where is this bubble going to pop? What's driving this problem? And let's take a look at this wider format shot here. Let's go into this screen and make it a little bigger. There you go. All right, so look. Here you got earnings growth. Earnings grew by 27% in 2023. It grew by 55% in 2024. Earnings in 2025 year-to-date, date of this chart, which was before year-end, 79%. That is significant. So for those of you who say, well, AI isn't working, well, okay, well, somebody's making some money, right? And if the Mag 7 is making most of the money, then their earnings are increasing. Yes, they are putting out a ton of money to build AI infrastructure, and yes, there are some downsides to this, but I don't think people understand how meaningful this problem is going to be, because we are not in an earnings recession. Earnings led the way in the market, which means that it is not just a bubble based on hype. It is a bubble based on material returns, and people are looking constantly at jobs saying, well, where is the change? Well, let me show you. This is the Mag 7 in this chart here, the Magnificent 7 2025 total returns data via Y charts, of course. This is from Charlie Bolello. I follow him a lot. I don't know if I ever say his name right. Google. Wow, 66%. Okay, that's a return. Okay, Nvidia 38.9%, S&P 500 17.7%, Microsoft, Meta, Tesla, Apple, and Amazon. Okay, all below that. That's the average. So it wasn't just the Mag 7 leading the market. There were some outsized players here that really showed performance. And that there you are. You know, I mean, that's, if you invested all your money in Google and all your money in Nvidia and you were concentrated, you had a good year. Okay? So it's kind of hard to ignore that. The surprising outlier was Amazon. I honestly believe that Amazon might be the breakout performer this year, because I do think that Amazon has the potential and the money to really do something meaningful in this space. So Apple, for a while, to me, has been underwhelming in that their products being so behind the market has been a little bit too long in the tooth. Samsung, I think, has kept up. Tesla has underperformed as of today. We'll talk about that in a little bit as well. For one of the Mag 7 stocks, they missed a critical milestone in deliveries today of vehicles, which we're going to talk about in a moment. Meta, we know, has invested a ton of money. They started off with the augmented reality and now are in the virtual reality. Sorry, they started off in virtual reality, now into the augmented reality. I think they're going to be a late bloomer in this market, but Mark Zuckerberg has made it clear he's not afraid to spend the money. Microsoft, to me, is not the biggest player in the space, but continues to grow and build it the way that Microsoft always does, but they're not as sexy as the rest of them. Nvidia, you knew, was leading the way. I think for most people, this 66% is really what surprised a lot as far as the total returns year over year go, because it wasn't talked about a great deal in the news anywhere near the way Nvidia and the hype was. And that's, you know, goes to show you that sometimes the headlines can be a little bit look over here, smoke and mirrors. Let's talk about Tesla. This was breaking news a little earlier in the day, but I feel like we'll share it. And I do have an Apple News subscription for those of you that are interested. This from CNBC. Tesla reports 418,227 deliveries for the fourth quarter, down 16%. That is a big problem, particularly when it's a miss. Okay, so they did some interesting things. They started talking about consensus from other people besides analysts to try to soften the blow, basically trying to get out in front of this from a media perspective, saying, hey, we might be missing our deliveries here. Shockingly, the part that really blew me away was this part. The electric vehicle maker faces steep competition across the globe from companies including BYD, who is now the biggest auto manufacturer in the world. That's crazy. Crazy, crazy, crazy. And if you've seen their cars, they're amazing. It makes all the sense in the world. The fact that we don't have them here is kind of nuts. But this also coincides with the $7,500 federal government incentives for EVs coming to an end on September 30th. So the incentives certainly did not help. But I think there's a bit of a falling out of love with EV culture. I drive a Rivian. I love EVs. I'm not saying that I have an issue. But here are the key numbers. Total Q4 deliveries, 418,227. Total Q4 production, 434,358. 2025 deliveries are projected to be 164. I think actually they're finished by the time it's done. And total 2025 production, 1.65 million. So Wall Street expected 426,000 deliveries for the quarter, according to estimates compiled by Street Accounts. So this was a miss on deliveries. They were short of what they wanted to be. You will hear from Elon Musk towards the end of the month. I want to say in the third week or so, where you will hear him on the earnings call address this more specifically. But again, Tesla's infrastructure is much more than just EVs. It's also data. So you have to understand that this is a temporary problem for him. He's gotten much more vocal as of late with things like his robo-taxi business and some of the other things that Tesla is doing. So I don't think you count Tesla down or out. I think the hardware portion, the vehicle delivery portion, is lagging a bit, and it's going to as America continues to come to terms with where they are with EVs. But his ability to get data and grow these companies has been unprecedented, and he has a monumental pay package behind it. So more there to be seen. Let's jump over to S&P 500's dividend yield ending the year. I think this is also an interesting thing as well. So now we know that earnings have gone up, and we've seen most of the performers perform relatively well. This from my friend Charlie Bolello once again, and I'm going to go ahead and take this on the big screen here and then move you to the social view so you can see it in the column. All right, S&P 500's dividend yield ended the year at 1.15%, its lowest level since 2000. That's kind of crazy if you ask me. So Let's look at this in a little more detail. This chart here shows you the dividends quarterly from Q4 1988 to Q4 of 2025. You had some notable milestone peaks there, 3.87%. You guys probably can't see that very well. Let's grow it up a little bit. Let's go to the screen here. There you go. So you got 3.87% there. You've got 3.42%, and then you've got this down here. And the answer is actually surprisingly simple. For those of you going, well, Chris, if it's so simple, like, why are we covering it? Because I think it's important to talk about. Companies are making more money. Employees are not getting paid to keep up with from their wages perspective, and companies are distributing less money than they had, at least since 2000 in and of itself. You had a low point of 1 point, and let's clear this off a little bit to make it less. There we go. You had a low point of 1.12%, and right now we're really at 1.15%, which is effectively the second lowest number since 1988, which means companies are so spending heavy on things like capital improvement, and they know they need to spend a ton of money on CapEx, capital expenditures, that they're not giving that money back in the form of dividends. And because of this, you now have a bit of an interesting problem. Companies are earning more money. They're being more efficient. They're using things like AI, paying employees less money relative to inflation. And keep in mind, they're moving their valuations up on the products they sell. Everything they sell requires them to make more money. So earnings are up. Wages are relatively flat or down when you compare them to inflation, and they're now distributing less money. So what happens here? What's the catalyst? How does this change? Well, let's get into that a little bit, shall we? Every once in a while, let's clear that off. I got to use multiple hands here. This chart I'm going to show you here is an interesting chart, and I wouldn't call it a chart, it's just data. But this is your NASDAQ returns by year. 2025, a 20.17% return. And if you go down this list, let's see if I can make it bigger. Probably can't make it bigger on this chart, but I'll do that later. All right, so 2024, 24.88%, 2023, 53.81%, 2022 was negative at negative 31.97%, but you made that up in 2023, growing at 53%. These are big numbers, big numbers in the NASDAQ. The NASDAQ, again, for those of you who aren't familiar, is very tech-centric. So when you compare that to something like the S&P 500, where you had earnings that include a lot of these other companies, but also include the 493 other companies, you get a less sexy return. I'm looking for that return number here for you. 2019 in the S&P, 31.2. 2019 in the NASDAQ, 37.96. 2020, 18%. 2020 here, 47.58% in the NASDAQ. 2023, 26.1% versus over here, 53.81% in the NASDAQ. And let's just go to 2025. 2025 was actually the closest. The NASDAQ was at 20.17 versus the S&P 500 at 19.4%. So you can see the returns are, equivalent in some years, but certainly outperforming other years in the NASDAQ. The QQQ, on the other hand, the top 100 performing ones are actually much better than that. And that is part of the reason why we suggested it on the show. Let's go down to efficiency, tech, and rising unemployment. So companies, let me go to the wider shot here. Companies aren't failing. They're optimizing. It's pretty obvious from the things we're seeing from the earnings and from the dividend numbers that we showed you. It's a good sign, but let's unpack this whole 79% number that you saw. Mag 7 drove 26% year over year of those earnings versus just 4% of the other 493 stocks like we talked about. So yes, okay, earnings contribution is rising, but it's still heavily concentrated. The quality of improvements is real, but not evenly distributed. So you have to watch in 2026, the Mag 7 growth is expected to slow to about 15%, which ironically is in line with JP Morgan's put the market for the S&P 500. The 493 accelerates to about 10%, still below the Mag 7 growth. That's where this gets really interesting. Innovation stocks now reflect a record 49% of the S&P 500. That's huge. Almost 50% of the S&P 500 are based in innovation. This is according to B of A research. This percentage has more than tripled since the 1980s. And I think that's an important point to note. And it's something that Saeed and I covered on the show. And I think it's worthwhile to share that if you do believe in technology and you do believe that we are becoming more technologically dependent as a society, we have mobile devices, we have more fast, upload speeds, we've got things like satellites in the sky, then you have to believe that innovation stocks coupled with AI are going to be where you see the outpaced growth over time. I don't know that our technology around coal, around electricity, is going to get that much better in the near term, because it all comes down to those same innovative stocks, which will then impact those other companies as that innovation grows, if that makes sense. Back in the 1980s, 66% of the index market cap came from manufacturing sector. And I know you're saying, Chris, prove it. Okay, there you go. Here's a chart, Exhibit 21, S&P 500, 50% assets light versus 70% manufacturing in 1980. And what we're really doing on this chart is we're comparing 1980 here to 2025 here. And we're looking at particularly the innovation, which is this block here. And we're comparing that to things like manufacturing, which is the orange block there. So you've seen a material flip. And some of this has to do with us offshoring things like manual labor. We thought we were being intelligent in the 70s and 80s and saying, hey, we're going to offshore all that to other countries. And because it's in those other countries, we're going to focus on really intelligent growth. Well, we kind of got that intelligent growth. And because of that intelligent growth, it's been kind of interesting to see how this has transformed our society in a way maybe we didn't expect. If you're a journeyman or you're an electrician or plumber or something to that point, you're pretty good right now because AI isn't going to displace you a whole hell of a lot. But in the technology space, there's people who are, artists, illustrators, they're being displaced left and right. It's a problem. So by comparison here, this percentage has declined 49 percentage points to an all-time low of 17%. This number here. Okay? Financials and real estate have grown about 12 percentage points to, again, 17%. Those three numbers up top there. Tech companies have reshaped the entire U.S. stock market. So as much as we want to, bastardize, if you will, the Mag 7 and the tech sector, you have to understand that if 49% of the market is innovation, and every time somebody says on an earnings call, yay, they're talking about AI, they're going to be more efficient. You know what that means? That means they're going to replace people with technology to make more money and be more innovative. And yet, guess what? They get returns for that by doing this here. So I don't think that you can say that this is a bubble that's going to burst, because if it did, it would take down 49% of the market. You got earnings behind this. Companies are more profitable now than ever. So what is it that's going to be the thing that drives this market down? Syed, I see in the comments, brother. The rate of technology advancement is exponential. Tons of examples. Yeah, there are tons of examples. And because you're not here, I'm going to do this to you because I can. Let's see here. There we go. If Saeed were here, his contribution would be this. The rate of technology advancement is exponential. Tons of examples. Yeah, it is. It is exponential. There are tons of examples. And the problem is it's easy to call this a bubble and walk away. It's easy to say, hey, man, this is a bubble that's going to go away. But how can it? If 49% of the market depends on it, is that really what we want to happen? Do you really want to see these stocks here fold? And what would that do to the overall economy? So I think a lot of this stigma as it relates to fear-mongering is probably unwarranted. This explains essentially that the S&P 500 composition, which is now about 50% asset light versus 70% manufacturing heavy in the 1980s, shows higher margins and price to equity today. You're going to hear a lot about price to equity in 2026. A lot about this. This is going to be the focal point for what a strong company looks like. It's going to be all about this. And it's always been a metric, but you're going to hear more about it in 2026, particularly in the first couple of quarters as companies start to report. This wasn't that hard to predict. And despite popular belief, this was something that was long in the making before AI. Because AI has only been around for a couple of years now. This transition, look, 14%, 20, 22%, 24%, 30, 31%, 35%, 49%. Okay, these numbers are not anecdotal, they're not accidental, okay? These numbers have been increasing at a cadence, and yeah, you got a big jump when AI rolled out, but this is not new. This is not new. This is not something that's been unanticipated for a long time. It's just a local focal point, local focus point right now. But over time, you'll see this as actually increasing. U.S. manufacturing started moving overseas in earnest in the 1970s and 80s, like I talked about, accelerating significantly due to lower labor costs, trade policies, NAFTA in 1994, China joining WTO, and in 2000 in tax incentives, leading to major job losses in the U.S. by 2000s and beyond. Everybody found different jobs. Okay, I get that, especially as China became a production hub. Let's talk about some key periods here which emphasize this and talk about it from a place that I think is valuable for context. In the 1970s, 1980s, this was kind of the start of what we're seeing here. Companies began exploring lower wages in developing nations, especially with China, leading to large-scale outsourcing factories for work. What do you think companies are going to do call center-wise? Right now, I think the call centers are largely focused in the Philippines. It sounds like that's where most people have gone when you start doing the research. They used to be in India and some other call centers, but I think the Philippines kind of have that now. It makes sense. They're very native English speaking culture. The cost of wages are low. Is that going to be displaced by AI? 1,000%. That's going to happen. You're going to see those call centers go away. And the question is what are those developing countries going to do to offset those loss of wages in their countries? So this is a worldwide problem now. In the 1990s, this accelerated. Free trade agreements like NAFTA made moving production easier, while deregulating and tax policies further incentivize moving jobs abroad. So we actually financially incentivize this by people getting taxed less because they're not paying the taxes here as they once did because people aren't here. In 2000, there's also another major shift. China's entry into the WTO, the World Trade Organization, in 2001 cemented its role as a manufacturing powerhouse, causing a significant drop in U.S. manufacturing jobs, which never fully recovered. And today, not only do the U.S. manufacturing jobs never fully recover, they're also being continually displaced by AI. So expect that 49% innovation to be more and more impactful over time. The ongoing trend, of course, is the process expanded from basic manufacturing to include higher skilled jobs, IT, R&D, accounting in the 2000s and beyond, driven by globalization and technology. There is no reason, and lots of large banks do this, where you can't take some accounting functions and offshore them. You can pay those people a lot less. Their specializations here, they cost more. Over there, they're specializations, but they're a whole hell of a lot cheaper. And guess what? AI will come for those jobs too. So what happened? Lower labor costs, access to vast pools of cheap labor overseas. You got to understand that does impact your willingness to pay people more money here. It used to be your long tenure somewhere meant that you were a good employee, you were paid for, you were taken care of. But guess what? Long tenure now means you are likely underpaid relative to the market. That's a terrible thought. Economic incentives, favorable tax policies like no tax on unrepatriated overseas profits, encourage reinvestment abroad. So yeah, you didn't get taxed if you left the money overseas that you made. So what did you do? You reinvest that money overseas, and then guess what? That reinvestment abroad grew your infrastructure there and then helped you build out a business there, which now costs you less from a tax basis here. So you actually encourage people to continue to grow. Now, of course, there's global competition here. Companies sought lower production costs to compete abroad, and that's a problem. This shift led to the deindustrialization. That's right. The deindustrialization of parts of the United States, particularly the Midwest, which had a long history of this. Think Michigan, the home of the automotive industry in Detroit. Once a sparkling gem that had this whole revitalization have to happen in recent years because so much of the business left. Hollywood is seeing this right now, right? And a long-term decline in manufacturing employment from its peak in 1979. So there's an argument that so far, AI investment has not had a major impact on GDP. Okay? But it's not just an argument. Here's a chart for you. AI impact measured on US GDP level, semiconductor purchases, they're there. Measured AI-related CapEx, that's there. All the money they spend, that's this blue bar right there. It's the biggest one. Like I told you, there's a lot of money going into CapEx. It's part of the reason why you're not seeing the dividends get paid out. They need that money to continue to build. Net imports of semiconductors and AI-related products, total effect on total GDP and total effect on measured GDP. These red lines are what you really want to focus on here. And you can see they are relatively flat. There you go, right there. No measured effect on GDP. So all this AI in the system, no measured effect here. Jerome Powell would point to this and go, look, there you go, Chris. See, right? If there's no measured effect on GDP and there's no measurable impact on jobs, then AI isn't really the problem. Well, maybe now, but you have to look back at the other chart I showed you. The lack of industrial growth in this country is the problem. And the other problem, the one that we're ignoring, is not just AI based. AI is an easy cop out. The real problem is the innovation, not AI. AI is just the latest of the innovation segment. It's this chart here where we focus on this piece. This innovation piece is what's changed. That's the material difference. You're starting to see this now. AI is only going to exacerbate this by accelerating it. That is the problem the market is ignoring. You've not seen this, and he's right. Jerome Powell would be right if you were here and he were being a pundit for it. He was absolutely right. But what you were going to see is an accelerated growth in this. AI is impacting the economy, but not in the way that GDP is currently designed to capture. That's the other problem, okay? That creates the illusion that profits, jobs, and inflation are behaving, quote, wrong. I would argue that you're going to see these measurements. And let's take a pause here for me to share with you. These measurements that we look at have been designed for the last 100 years. Why are we not looking at them saying there's a better way to do this? And every time I switch to this camera, I feel like I'm too low and maybe I'm slouching. But there's a better way to do this, okay? And let's look at housing. Housing, we know, is a lagging indicator. There's way better ways to collect the data and report on the data. Why are we not doing that? Why are we so antiquated that we're relying on stuff that we know is 6 months behind when 6 months are materially important in this world, in this economy? I don't know. I don't get it. I don't fully understand. Let's see who's still with me in the comments. Anybody still there? Sean, you're still there, brother. What's up, my guy? So you've been saying I should have done child daycare versus doggy daycare. Not really. Let's see here. I'm going to scroll to the comments for a little bit because let's see what we got here. Let's go to the chat. There we go. I'm so used to pushing buttons. It's kind of cool how you can see different people come in from different channels. YouTube seems to be the most focused one for us here, but we got a bunch of different people come through. Matt, we out here. What's up, Matt? I got to figure out a way to work the infrastructure. So I'm going to put a big wrap on this in the next 30 minutes where we're going to talk a little bit about GDP and some CapEx, and then we're going to talk about some of the things to expect in the week to come. There's a lot of reports coming out that I think are important to be noteworthy and mindful of, but this is a bit of a slower week, if you will, relative to the rest of the market. And I think it's important for us to talk about some things. And your point here, Matt, I'm going to actually highlight and comment that this is actually a really good one because I agree with you wholeheartedly here because it's just facts. But let's see here. There it is. This is from Matt. There you go. I'll remove the chat. ROI over 5 years, VOO 83% versus QQQ 96%. There you go. The economy has clearly favored innovation, like it or not. That's a real return. And I'm not saying that someone like a Warren Buffett, by the way, would not support this or believe in it. I'm just saying that someone like a Warren Buffett has traditionally not believed in things that weren't asset backed. And right now, some of the innovation that we're seeing is backed by earnings, but not an asset that he would fundamentally look at. It's intellectual property, which is an asset, but it's not as tactile as I think he would probably like in some circumstances. Although AI is, it's going to be revolutionary. I believe that. So let's get into a couple more points here on GDP, which I think are important here. AI, it's going to impact the economy in a way that we haven't seen so far. It's going to accelerate and exacerbate all this. But GDP is a measurement problem. GDP measures spending, not efficiency. Most of AI's impact so far is happening through cost reduction, fewer workers per dollar of output. Okay? That means lower employment numbers, or higher unemployment, lower employment numbers. Productivity gains inside firms, you're being more efficient, and faster decision-making, automation, and software leverage. So let's make that very clear one more time. Cost reduction, productivity gains inside firms, and faster decision-making. Those show up as higher corporate margins, making more money. They don't show up as higher GDP yet. Okay? So if we have higher corporate margins, companies are making more money. Employees are not making the same cadence of more money. And GDP eventually will start to absorb this and see the growth. Where is it going to come from? Well, the large overwhelming majority of GDP is consumer spending. So there's also likely a decoupling here. I think you're going to see a decoupling of employment and inflation. And I think you're going to see a decoupling of GDP and corporate margins. And I think that those two aren't going to be quite the same as they once were. Semiconductor investment, as you probably have guessed, is also not GDP focused. You're not going to get any chips are often imported from other countries, not in the United States. Imports subtract from GDP. They don't add to it. And Well, massive AI buildouts can reduce measured GDP. So if you're building out a shit ton of AI, well, guess what? Then that's going to reduce GDP costs because of the way it's accounted for. It looks like an expense in the line item. It doesn't look as like growth. AI does not AI capex does not equal AI output. You're seeing a huge amount of companies put tons of money into build out of AI currently. Data centers and GPUs are inputs. The value creation happens downstream, faster services, fewer errors, cheaper labor. So you're not going to see it now. The value creation will be later. So you have probably a good 5 years of data center and GPU build out, creation, and capex before you really start to see the AI output even grow more exponentially than you're seeing now. GDP doesn't credit those gains unless prices rise or outputs expand. AI replaces labor, not consumption. And we, as a society, consume. AI does not generally. I've broke down the reasons as to why. So if AI replaces a worker, GDP may be flat or lower. So as you start to replace workers with AI, GDP, again, decoupled, stays flat or goes down because we are not spending to buy things because we do not have jobs. We do not have the same level of income. Things cost more. Inflation gone up. Wages stayed flat. This is a problem that we are now seeing a decoupling with going into 2026. But if profits rise but profits will rise because costs will fall. So efficiency we're seeing is likely not going to come in the course of them being able to sell more product. All they got to do is sell the same amount of product if they can have AI come in and be more efficient. If you can get incrementally a little bit more as far as product price goes, then guess what? You're getting the best of both worlds. So I think there's a pretty palpable and real problem ahead of us for 2026. And I think that AI and innovation and this technology segment are likely going to be problems for the U.S. economy for the indefinite foreseeable future. And everybody worrying about a bubble, yeah, it is a bubble. It is a bubble where everybody's focused in it because everybody's going to get returns from this. And until such time as people don't, or there is a fundamental problem, and I can't tell you what that's going to be because earnings are already there, then what's going to stop it? That's the question. And I don't know that I have an answer at this point in time. So we are now at 12:31. We got 30 minutes until the stock market closes. The ticker you're seeing down here at the bottom is in real time. It looks like the market is largely up. We have added 49 stocks that we constantly watch down here at the bottom in the market, and you see them trading here in real time live. You will see a yellow D on a company that's going to have dividends coming up. That D will glow if it's in the next 24 hours. I am going to add an earnings component to this to talk about earnings, but that's a separate module at some point in time. For right now, just focus on these companies down here. If there is a company that you want to see watched and monitored on the show, let us know. It's very easy for us to add it. We aren't going to add like a random stuff, like random pink slip companies. But if there's somebody down here you think is important and indicative of the market, let us know. We will add it. These are companies that we felt were from different sectors. I've got some consumer stuff down here. We got some banking stuff and finance stuff. That's what you're looking at here with I think it's BlackRock, Schwab, and Blackstone. You've also got Tesla coming up in here as well. Tesla being down largely 2.25%, it looks like here because of that miss of deliveries. But that's not a huge drop as far as I'm concerned, and it's not a huge miss of deliveries. I think they're just easy to get caught up here. Netflix surprises me being down, but they're in that hustle conversation trying to acquire somebody, so that happens. And there's your first D from Oracle showing that they are going to have dividends coming up. So this chart is hopefully designed to be meaningful. If there's something that you think watching this can add some value to it, please let me know. I'm going to go to the chat here and see if anybody's got, oh, fancy. Yeah, fancy site. That's you, though. Bro, you can't be the only person commenting here. Guys like Naval, Elon Zuck, Sam Altman in favor of UBI. Are you concerned about it? No, I think UBI is a cop-out. Universal basic income. I don't think it's I don't look. This is going to slant a little political here, but I'm gonna go with it a little bit. We have for the longest time been a very capitalism-focused country, and UBI, in my mind, gets close to teetering on the brink of socialism standards. But asterisk here, I understand why UBI is attractive and what people like Elon Musk are saying. Elon Musk in interviews has said that he sees so far out where the basic work of humans is done by a robot powered by AI, and that we need to have somebody paying us some type of basic minimum wage that we can kind of build off of. I hear that argument. I do. I think Mondani in New York got elected largely because of ideals that I think echo a little bit of socialism standards, are because he has a disenfranchised youth. The economy in New York is expensive. It's really hard to buy a home there. It's really hard to live there. And if you're someone like him and you come along with a different message, it's attractive to a younger demographic who's discouraged. I mean, look at them. They were brought up to believe in life, liberty, and the pursuit of happiness. And the pursuit of happiness, as originally drafted, meant ownership of property. And they're unable to do that. And yeah, you could probably get outsized returns by going into the S&P 500, but I would say for most people, investing in the stock market is probably scarier than investing in real estate. And the reason why is your stock market valuation is not something that you tactile, live in. You don't have the appreciation for the utility, but you see the value go up and down every second. Look at the stock tickers down here. If you invested in Nvidia, every day you can easily watch it. And you saw this during the great financial crisis, where people invested in 401ks, were looking every single day at their 401k going, oh my God, I lost so much money. But it's like, no, those are unrealized losses. You haven't actually had to sell yet because you aren't retired yet. Now, if you were of retirement age, that would have been a big problem. That could have been problematic. But you also didn't have to sell those assets down. It just meant you had less in your account at that point in time. And if you were invested in some of these indexes, you've recovered a great deal since then. But again, time, value of money. This is where someone like Warren Buffett, who's been investing for 60 years, has outsized returns because he's been investing for 60 years. So there it goes. Did it freeze, or it's just me? I think that's just him, hopefully, right? Is that just him, Regil? Regil says it's still going. It's just you, Sean. Love you, but get better. I shouldn't talk trash. I was going to talk trash, but I realized that us started the show a little bit on the wonky side, and for some reason I can't get audio on the platform. So who am I to criticize? Who am I to judge? Let's pull the chat off here for a little bit, and let's go over some things I want to talk about from a macro calendar schedule. All right, so the week ahead, we got some interesting things coming up here. We got major schedule reports and releases Monday, January 5th. There typically aren't a lot of major government macro reports that come out in the first week of the year, so particularly because we had a government shutdown that we just came off of. So after the New Year's holiday, expect a limited release. This is actually wound up perfectly for our show, so I don't have to go into a whole bunch of detail here, but you will get some private sector and manufacturing PMI updates. They may show up here in the first couple of days, but Tuesday, January 6th, you are going to get some first reports, job openings and labor turnover survey, also known as JOLTS, on Tuesday, January 6th. Reports released by the Bureau of Labor Statistics show labor demand and quit rates, a leading indicator of labor market strength, at about 10 a.m. Eastern. You who do listen to the show know that is one of the favorite reports of the FOMC to look at for the overall strength of the jobs market. I do not expect that to be wildly favorable, but I do think that the November 2025 report, which comes out at 10 a.m. Eastern, will show a lot of holiday hiring and whatnot. So I don't think there'll be a big swing there. If anything, it'll kind of slant positive, is my guess. You're gonna get state unemployment and state employment for November at a monthly level. I think on the same time. That's also Tuesday. So Tuesday is going to be your employment day. Wednesday, January 7th, look for ADP private employment payroll for December, not November, and ISM service non-manufacturing PMI on many private calendars. These are early reads on jobs and services sector activity. So you also get some earnings that day. The only two that I really found were noteworthy. You're going to get Jefferies, major investment house. I've worked with Jefferies before. I think they'll tell you the strength of the overall financial market as far as M&A activity goes, which I expect to see pick up. I don't think private equity is going to exit as much as they did in the last couple of years this year, but I certainly think that they're going to want to, and I certainly think that that's going to happen. Anecdotally, we also heard that Sprinkles is shutting down, bankruptcy. Private equity purchased about 10 years ago and now shutting down. That does not surprise me based on private equity's cultural changes to the institution. I think that was a you don't buy a cupcake business if you don't love the culture. The other earnings report we're seeing is Albertsons. To me, grocery shopping is a very big indicator of the overall financial health of the economy. You do see people eat more when they feel like they've got more money. I know it's terrible to say, but that's why they say the rich get fat, which clearly I'm not rich. All right, Thursday, January 8th, no major government headline macro releases are scheduled, but some sector and business data are productive. You'll see some stuff come out, but nothing that's I think is meaningful. Friday, however, you are going to get more employment data. The first major macro week since the close of the U.S. Job report. The employment situation, you'll get December jobs now on Friday. Unemployment rate, wage growth, and you get some releases by the BLS, typically around 8:30 a.m. Eastern time, so I don't check it until way later in the day. You get some hourly earnings and unemployment details as well. What isn't scheduled, I think, is more important this week, but does come soon. You get CPI in mid-January. You get PPI in mid-January, producer price index. You get retail sales and trade data typically in the middle of the month, and GDP and inflation data later on in January. So that is the show. I did cut it a little bit short as far as content goes because I was more concerned about not having audio on the segment. And I got some extra time. Jesse Baldivino, him. Who's him? Just me. Did it freeze or just me? Just him. Yeah, just you. All right, kids. Let's bring the chat up. And let's talk for a little bit. Let's see what we got here. So are you saying I should childcare versus daycare? That comment's still stuck in there. It's hilarious. Maybe it's because they want the childcare. Yeah, UBI sucks. I don't think you should go to UBI. All right. A couple of house cleaning items. Assuming I can figure out this show and get it to where we want it to be. The intent is to be a more technical show like this. I need to know if you guys like it and if you guys think that it's valuable relative to the podcast. Relax, Sean. We still love you. What's going to be important for us is that this serve as a companion to the existing podcast, not a replacement for it. We're going to continue to do the podcast on a weekly basis, doing weekly drops on Tuesdays, educational content on Thursdays, and the hope is to get this seamlessly running. Obviously, today was not so seamless, to where we can get a Monday, Wednesday, and Friday show. That is a bit aspirational at the moment because I'm still trying to figure out some things that I'm going to pose to you all as questions. Number one, I want to find a way to make the show engaging. The hope was that the comment section that we added here and some of the drawing stuff would help it being a little bit more interactive and engaging. But I also think that there needs to be something more here. I thought about bringing in guest interviews, and I've got a setup for that, which I'll share here. It's basically this perspective here. We'll do a side-by-side if you want to take a look at that. But it'll largely be me in the beginning, and then we'll bring Saeed on at some point in time, and Rajil as well. Rajil is here to kind of help me make sure that things are going smoothly on the technical side. One of the challenges I have is I can't see what you guys see. So I don't know if the audio is coming through, for example. I am happy that the bar and the ticker came through. So for those of you who are watching, you like the ticker, let me know. If you want to add stock to it, let me know. And then what you think might be good adds to this would be very helpful. Saeed and I kind of guessed at a lot of things that we thought would work. But again, there's no real magic to this. It's kind of one of those things where it works if you say it works, and it doesn't if you say that it doesn't work. So to that end, I'm going to here shortly press the end screen button. And hopefully what it's going to do is it's going to take us out. But before it does, I wanted to test one interesting thing. And you guys tell me if you guys can hear this, okay? This is God forbid we have an issue and the stream goes down, I want to show you real quickly what you would see. It would look like this.